Welcome to the Pro Ticker Deep Dive.
It's great to be back.
Today is Tuesday, February 17th, 2026. And I have to say, if you've been watching the charts this morning or, well, really any time in the last 3 weeks, the atmosphere out there is
It's thick.
thick, doesn't even cover it. It feels suffocating. It feels heavy. You open up the terminal, you look at social media, and there's just this palpable tension in the air.
It's a very, very unique moment in market history. I think tension is absolutely the right word, but I'd also call it a stalemate. Or maybe a high-stakes game of tug-of-war where the rope is made of razor wire.
That is a vivid image, but it feels so accurate because on one side, you have retail investors who are they're absolutely terrified. We're seeing panic selling. We're seeing capitulation.
People are just throwing in the towel.
Exactly. But then you look at the other end of that rope and you've got the institutions, the whales, the ETF issuers, and they're pulling back harder than ever. They're not scared at all.
No, they're hungry.
They are hungry. And that disconnect, that's what we are going to unpack today. It is so rare to see sentiment this divided. Usually, the whole market is euphoric or the whole market is miserable.
Right. It's all one direction. But right now, it depends entirely on who you ask. The quote-unquote smart money is buying aggressively, while the street is just panic selling.
And we have a massive stack of analysis to get through to explain this split. We're going to look at the Bitcoin paradox, why the fear index is at a historic low, while institutional buying is at a record high.
And we have to go to Washington. We have to figure out why the Clarity Act, which was supposed to be our regulatory savior this year, is basically stuck in the mud.
Oh, absolutely. That regulatory piece is crucial.
It really is. It's the boring plumbing that actually dictates where all the money flows. And right now, there's a massive clog. And that clog is called stablecoin yield.
And then we're doing a huge deep dive into XRP. I mean, the narrative there has completely flipped on its head.
Completely. 180 degrees.
It's gone from being the retail army coin, the rebel, to being the institutional rail. We've got Goldman Sachs getting involved. We've got ETF inflows that just defy logic in this market.
And a very, very heated debate about where the price is headed for the rest of 2026.
It's a fascinating case study in how an asset matures. But let's not get ahead of ourselves. We have to start with the broader market sentiment because the numbers we're seeing there are genuinely shocking.
They really are.
Okay, so let's unpack this. The Fear and Greed Index. It's a classic. We check it all the time. Usually it bounces around, 20, 30, maybe 40 when things are looking bad. Where are we sitting today, February 17th?
We are at a score of 5.
5. Just 5 out of 100.
5. F-I-V-E. To put that in context for you, that is essentially extreme fear with a capital E in flashing neon lights.
That can't be right.
It is. That is lower than the sentiment was during the FTX collapse in 2022. It's lower than when Terra Luna crashed.
Wait a minute. Worse than FTX. That was a global catastrophe where billions of dollars just evaporated overnight because of outright fraud. Why is the vibe so bad right now when all the infrastructure is actually working? The ETFs are fine, the exchanges are solvent. What's driving this?
I think it's a combination of fatigue and just the relentless price action. See, when you have a sudden crash, like with FTX, people get an adrenaline rush. They react. But we've had this choppy downward grind for months now.
The slow bleed.
The slow bleed is so much more painful. Retail traders are looking at their portfolios. They see red month after month after month, and they're panic selling just to make the pain stop. We're seeing short bets piling up on the exchanges to record levels.
And social media is a nightmare, I assume.
Oh, it's an echo chamber of doom. If you scroll through Twitter or Reddit right now, the dominant narrative is that the crypto bubble is imploding. Full stop. End of story.
It feels like the end of the world for the little guy. But here's where it gets so interesting. If the world is ending, nobody told Michael Saylor.
No, he certainly did not get that memo. He must have missed that email.
We just got breaking news about his company, Strategy, what used to be MicroStrategy. While the fear index is sitting at a 5, what did they just do?
They just bought another 2,486 Bitcoin.
How much is that in dollar terms?
That's an acquisition worth roughly $168 million.
So, not pocket change. And they didn't catch the absolute bottom, right? They weren't sniping this at $50,000.
And look at the price point. This is key. They paid an average of about $67,710 per coin. They aren't trying to time the absolute bottom. They are dollar cost averaging up here, buying right now in the middle of all this fear.
It's a pure conviction play. What does that bring their total holdings to now? It has to be an insane number.
It is. It's over 717,000 Bitcoin.
717,000.
To give you some scale on that, that is approaching 3.5% of a total supply that will ever exist.
That's a nation-state level of accumulation. I mean, just pause and think about that. One publicly traded corporation holding almost 3.5% of the entire monetary network.
It is staggering. And it signals something incredibly important about corporate conviction. When you see a player like Strategy continuing to accumulate this aggressively at these levels, it tells you that their fundamental thesis hasn't wavered one bit.
Not at all.
They view this price volatility as noise. It's an opportunity. For the average person, volatility is a threat to their rent money. For Saylor, it's an acquisition window.
I want to just pause on the mechanics here for a second because I think people gloss over how they're actually doing this. They aren't just using cash from their software business to buy this much Bitcoin.
Oh, not at all. The software business is just the engine room. The corporate treasury is the entire ship. They're issuing convertible notes.
So they're taking on debt.
Essentially, yes.
Yeah.
They're borrowing money from massive institutional investors at very, very low interest rates, sometimes close to 0%, and using that cheap capital to buy more Bitcoin.
So it's a giant arbitrage on the cost of capital. They're betting that Bitcoin's appreciation will vastly outperform the tiny interest rate they have to pay on the debt.
Exactly. It's a levered bet on the entire asset class. And when they deploy another $168 million during a market dip like this, it just screams that their long-term thesis is completely immune to short-term price action. They're playing a totally different game than the person trading on their phone on the subway.
And it's important to note, he's not alone in this, right? This isn't just one guy with a laser eye profile picture on a solo mission.
Correct. Look at the ETF flows. Look at BlackRock. Their IBIT ETF is seeing record volumes right now during this sell-off.
So just to connect the dots for everyone listening, retail traders are selling their Bitcoin because they're scared of the price going down further.
And BlackRock and Michael Saylor are standing on the other side of that trade with a giant catcher's mitt saying, "Thank you very much, we'll take that off your hands."
It's the classic transfer.
It is a textbook transfer of assets from weak hands. People who are emotionally compromised, over-leveraged, or simply need the cash to strong hands, which are institutions with 5, 10, 20-year time horizons.
So what does this all mean for the price? Because we're seeing this incredible tug of war on the charts too. The technical outlook seems just as conflicted as the sentiment.
It is. The charts are incredibly mixed, which just adds to the anxiety for everyone.
Okay, so let's walk through it. Let's look at the bear case first. Why are so many people betting on a significant drop, maybe down to $50,000?
There are a few key indicators that are flashing some serious warning signs. The first one is the monthly RSI, the Relative Strength Index. It's showing significant weakness.
Which suggests what, in simple terms?
It suggests trend fatigue.
Yeah.
Basically, the powerful upward momentum that carried us to the recent highs has, well, it's run out of gas. The engine is sputtering.
Okay, trend fatigue. And I've also seen a lot of analysts mentioning something called NUPL. What is that?
NUPL stands for Net Unrealized Profit and Loss. It's a metric that measures how much of the network is currently in profit versus how much is in a loss position.
So it's a gauge of market pain.
Exactly. And historically, major market bottoms happen only when we reach a state of maximum pain, meaning a huge chunk of recent investors are underwater on their positions. The NUPL data suggests we aren't there yet. We haven't hit that full capitulation phase where everyone just gives up.
So the bears are basically saying, look, it just hasn't hurt enough yet for this to be the real bottom.
Precisely. They think we need one more final painful flush, maybe a quick wick down to $48,000 or $50,000 to clear out all the remaining leverage in weak hands before we can build a foundation to go higher.
Okay, that makes sense. It's a painful but logical argument. But then you flip the coin. You look at the bull case. Look at the funding rates on perpetual futures. They're negative.
Deeply negative in some cases.
Explain that to me like I'm 5. What does a negative funding rate actually mean?
Okay, so in the perpetual futures market, you can bet on the price going up, which is a long, or you can bet on it going down, short. If way more people are betting short, the market gets lopsided. To balance it out, the system makes the shorts pay a fee to the longs. That fee is the funding rate, and when the shorts are paying, it's negative.
So right now, people are literally paying money for the privilege of betting that Bitcoin is going to crash.
Exactly. The crowd, the overwhelming majority, is betting on a crash, and markets have a very funny way of punishing the crowd. You know,
When everyone leans to one side of the boat.
the market has a tendency to violently snap back the other way. This setup is a classic recipe for a potential short squeeze.
Right, because if the price ticks up just a little bit, maybe because Saylor announces another buy or some good news hits the wire, all those short sellers are suddenly losing a ton of money.
They're immediately underwater. And to stop the bleeding, their only option is to buy Bitcoin to close out their short positions.
Which creates more buying pressure.
That buying drives the price up even further, which then forces more shorts to cover their positions, and you get this feedback loop, this cascade of forced buying.
So we're basically sitting on a powder keg. It could explode in either direction.
We absolutely are. You have this deep conviction from the whales coexisting with extreme historic fear from the retail market. It's an incredibly volatile cocktail just waiting for a spark.
It really feels like everyone is just holding their breath, waiting for some kind of catalyst. And usually that catalyst, for better or worse, comes from the government.
It often does.
Which brings us perfectly to our second segment, the regulatory battlefield.
Ah, yes, Washington, the swamp.
So everyone was pinning their hopes on 2026 being the year of the Clarity Act, the Digital Asset Market Clarity Act. It was supposed to be the silver bullet, the thing that finally gave everyone clear rules of the road. But looking at our analysis, it seems completely stuck.
It is stalled, dead in the water in the Senate Banking Committee. And what's so fascinating here is why it's stalled. It's not because of the old arguments like Bitcoin mining energy usage. It's not really even about DeFi protocols.
Which is about stablecoins.
It's about stablecoins.
Right.
Specifically, it's about the interest paid on stablecoins, the yield.
This is the core conflict, the yield war.
That's a great name for it. It really is a war.
Break this down for us. Why is the simple act of paying interest on a digital dollar such a massive existential sticking point for the biggest banks in the world?
Well, you have to think about it from a bank's perspective. What is their core business model? How do they make money?
They take deposits?
They take your deposit, you put your paycheck in a checking account at, say, JP Morgan. What interest rate do they pay you on that money?
0. Or, if I'm lucky, it's something insulting like 0.01%, and they'll probably charge me a fee on top of it.
Right. It's effectively 0. But then what do they do with your money? They take it and they go buy short-term treasury bills that are yielding, let's say, 5%. They pocket that 5% spread. That is their profit margin. And it adds up to billions and billions of dollars a year.
Okay, so that's the traditional model. Now enter the stablecoin.
Now, imagine a stablecoin issuer comes along. It could be Circle with USDC or even a new bank-backed stablecoin. And they say, hey, hold your dollars in our stablecoin. We'll take the money. We'll buy the same safe treasury bills, but we're going to pass that 5% yield directly onto you.
Well, as a consumer, I'm taking the 5%. I mean, why in the world would I keep my money in a Wells Fargo account paying 0 when I can get 5% on a fully backed, transparent digital dollar?
Exactly. And that is the bank's absolute nightmare. They have a term for it. They call it deposit flight.
Because the money would just fly out of their accounts.
They are terrified that if stablecoins are legally allowed to pay interest, billions, maybe even trillions of dollars will flee traditional bank accounts and move into stablecoin wallets.
And if the banks lose all those deposits, they can't make loans. Their entire business model starts to crumble.
It threatens their very existence. So the banks are lobbying with everything they've got to ban it. They want a total categorical ban on any stablecoin paying interest to its holder.
And they're playing hardball on this.
Oh, extremely hardball. We're seeing analysis that bank representatives arrived at these high-level White House meetings, which are being hosted by Patrick Witt, who is President Trump's digital asset policy lead, with a document literally titled Prohibition Principles.
Wow, prohibition principles. That sounds severe. It sounds like something out of the 1920s with alcohol.
It was a line in the sand. It was their non-negotiable starting point. They want stablecoins to be treated just like physical cash, non-interest-bearing. They see them as a utility token for moving money around, not as a savings vehicle that can compete with them.
And I'm guessing the crypto firms, the Coinbases, the Ripples of the world are fighting this tooth and nail.
Of course. Their argument is that it's blatantly anti-competitive. They're saying the technology allows us to be more efficient and pass the value directly to the user. Why should the government step in to protect the legacy bank's outdated profit margins at the direct expense of the American consumer?
It really is a classic, Old guard versus new guard fight for the future of money, and it's happening right now in closed-door meetings in the White House.
It is.
Speaking of the White House, there's another layer of political drama to this that we're seeing in the reports.
There is, and it involves President Trump's own personal crypto holdings.
We're seeing reports that his publicly disclosed crypto portfolio is now valued at over $800 million.
That's right. And it's largely in meme coins, which is a whole other fascinating story, and some Ethereum.
Yeah.
But yes, the total value is very significant.
So the question that's being raised by opponents in Congress is his administration's strong push for this Clarity Act a potential conflict of interest?
It adds a very complicated layer to the whole negotiation. You have Democrats on the Senate Banking Committee who are questioning whether the executive pressure to pass this bill is for the good of the industry and the country, or for the good of one person's specific portfolio. It muddies the waters.
It gives the opposition a lot of ammunition to just delay and stall.
Exactly. And while they all argue about ethics and interest rates and political holdings, the market just waits. This isn't sexy stuff. It's boring bureaucratic plumbing.
Yeah.
But until this is resolved, until we know for sure if stablecoins can pay yield or not, a huge amount of institutional capital is just going to remain hesitant to fully commit to the payment side of crypto.
Because uncertainty is the enemy of investment.
Always.
Well, one asset that seems to be getting tired of waiting for permission is XRP. This is a massive part of our deep dive today because the shift in the XRP narrative for 2026 is frankly mind-blowing.
It's one of the most significant pivots we've ever seen in this space.
For years, for as long as I can remember, XRP was the rebel. It was the token fighting the SEC in court. It was the retail army, the XRP army, fighting against the powers that be.
And now, in 2026, XRP is the suit.
It is the suit. It has put on a tie and gone to Washington. It's pivoting so hard toward institutional adoption. Let's just run through the evidence here. First piece of evidence, Goldman Sachs.
This was a major revelation. A recent filing showed that Goldman Sachs has disclosed roughly $153 million in XRP-linked ETF exposure.
Goldman Sachs, the vampire squid itself, buying and holding XRP ETFs for their clients.
It signals a level of institutional acceptance that was just unimaginable 2 or 3 years ago. Let's be clear. Banks like Goldman do not buy rebel coins. They don't touch assets that might be deemed rogue securities. They buy assets they believe are legally safe and have real institutional utility.
And the ETF numbers back this story up completely. We now have spot XRP ETFs in the US. They were approved late last year. What are the money flows looking like for those?
They've seen over $1 billion in net inflows in just their first 50 days of trading, which is solid, very solid. But here is the statistic that really jumped off the page for me.
Go on.
They have recorded 0 net outflow days so far.
Wait, really? Not a single day where more money left than came in? Even the big Bitcoin ETFs have outflow days.
That's what the data shows. In a market where Bitcoin is seeing extreme volatility and the fear index is at a 5, people are consistently buying XRP ETFs and they are holding them. It suggests this is sticky long-term allocation money, not fickle retail speculation.
These aren't day traders. They're parking capital.
They are parking serious capital. And to top it all off, we have Brad Garlinghouse, the CEO of Ripple. Where is he spending his time these days?
Not in a courtroom with the SEC anymore.
No. He has been appointed to the CFTC's official Innovation Advisory Committee.
That is just incredible. From being personally sued by the SEC to sitting on an official advisory committee for the CFTC, one of the country's top regulators.
It's the ultimate signal of legitimization. You do not put the CEO of a rogue company on a government advisory board. It signals that Washington, or at least the CFTC, which regulates commodities, now views Ripple and, by extension, XRP as part of the legitimate financial infrastructure.
So if you've got institutions buying up the supply via ETFs and you've got the CEO sitting in the inner circle of the regulators, what does that do to the available supply of the asset? Because I'm reading a lot about this supply shock theory.
Well, this part is just simple math. It's supply and demand mechanics 101. Analysts are looking at the current rate of ETF buying. If these ETF continue on this pace and absorb, say, another 4 to 5 billion XRP tokens by the end of 2026, where does that XRP come from?
And the supply in exchanges are already way down, right?
So it's down 45% from its peak. So you have a decreasing finite supply of liquid tokens on exchanges. And at the same time, you have this new, massive, and very hungry sink, the ETFs, that is just vacuuming up tokens every single day.
It creates a mechanical squeeze.
It's a supply squeeze. It's less about retail hype and social media excitement and more about the cold, hard mechanics of scarcity. There physically might not be enough liquid XRP to satisfy the growing institutional demand without the price having to reprice significantly higher.
Okay, so the picture you're painting is one of increasing scarcity, massive institutional adoption, Goldman Sachs getting on board. So
Yeah.
let's talk price, because this is where the debate gets really heated.
It gets very heated, and it's a real culture clash playing out in these price targets.
On one hand, based on everything we just said, you'd expect the forecast to be, moon Lambo, $100. But then we have this new report from Standard Chartered that is, well, it's a giant splash of cold water to the face.
It's a full bucket of ice water. Standard Chartered just slashed their 2026 year-end price target for XRP. They cut it from $8 all the way down to $2.80.
That's a 65% cut, a massive downgrade. Why? Are they seeing something fundamentally wrong with the thesis we just laid out?
It's not that they see something wrong with the long-term fundamentals. It's that they're applying traditional finance risk management models to a crypto asset. Their report specifically cites prioritizing near-term risk management and concerns about short-term declines in a fragile market structure.
So they're just being boring conservative bankers.
Exactly. And this is actually a sign of maturity for the asset, as ironic as that sounds. When banks analyze a tech stock like Apple or Microsoft, they don't publish reports predicting 100x gains.
No, they predict risk-adjusted returns based on quarterly earnings.
Right. Standard Chartered is doing the same thing here. They're saying, look, the overall market structure is fragile right now. We see volatility on the horizon. Let's be conservative and responsible with our forecast.
It's almost disappointing, though, isn't it? Crypto investors are so used to the 10x, 20x predictions. A target of $2.80 just feels modest.
It does feel modest, but we have to be objective here. XRP is trading at around $1.48 as we speak. A move from $1.48 to $2.80 is basically a 100% return in less than a year.
That's a fair point.
In the traditional stock market, if you told an investor they could double their money in a year on a large cap asset, they would do backflips. In crypto, because we're so used to insane volatility, it feels like a failure. That's the psychological distortion we all live in.
We are definitely spoiled by volatility, but not everyone is being that conservative. We still have the bullish counter-narrative out there.
We do. There are plenty of other analysts who are sticking to their guns in the $3 to $5 range by year end.
And what's their core argument? How do they get to that higher number?
It really hinges on two main things. First, the Clarity Act actually passing and providing that regulatory certainty we talked about. And second, the institutional rail thesis actually starting to produce tangible results.
The institutional rail. This is where we get into the rumors about a bank like Citi, right?
Yes. There's a lot of discussion in the analysis about a major bank like Citi potentially integrating XRP-based systems for cross-border payments. Or, on a grander scale, the idea of XRP acting as a neutral bridge currency between different central bank digital currencies or CBDCs.
If that happens, then the value isn't just about speculation anymore. It's about raw utility.
Correct. If XRP becomes the plumbing for daily cross-border settlements between major global banks, the daily transaction volume would be immense. That utility value kicks in, and that pushes the price up regardless of retail sentiment or the fear and greed index. You move from a purely speculative value to a tangible utility value.
But for now, we have to look at the chart as it is today. You mentioned we're hovering around $1.48.
Yes. And technically, the chart shows a battle. We are stuck, completely stuck in a consolidation phase.
So what are the key levels that people should be watching on their charts?
To the upside, there is a very stubborn descending trend line that is capping all the gains. We need to see a decisive break above $2.10, and then the next major resistance is at $2.35. Those are the hard ceilings right now.
And what about to the downside? Where's the floor?
There's very strong support at the $1.26 level. If we were to lose $1.26, things could get ugly pretty fast. But for right now, we're just bouncing between those two zones. We're just waiting.
Waiting for the Clarity Act. Waiting for the Fed to make a move. Waiting for the macro world to figure out if it loves or hates crypto this week.
Precisely. We are stuck in the market's waiting room.
Before we wrap things up, we have to touch on a few niche narratives. Because even in a boring or fearful sideways market, there is always something popping off in some corner of crypto.
There is always a bull market somewhere. You just have to find it.
And right now, that bull market is in penguins.
Pudgy penguins. The PNG token, to be specific.
I remember when these were just cute little NFT JPEGs. Now the token is outperforming almost everything else in the market. Why? What's the story here?
The story is that they pivoted. They successfully moved from being just a collectible to being a product. They just announced a major partnership with Visa to launch a Penguin card.
A Pengu Visa card. So you're telling me I can go to a restaurant and pull out a debit card with a picture of a fat penguin on it to pay for my meal?
Yes, a real physical debit card that is accepted at 150 million merchants worldwide. But here's the kicker. It offers yield and rewards back to the user.
See, this ties all the way back to that stablecoin interest fight we were just talking about.
It does. They're finding clever ways to offer real-world utility. You can spend your crypto easily, you can earn rewards, it's tangible, you can actually hold the card in your hand.
And the key insight here for the broader market is that narrative strength wins in the end.
It's the narrative shifting from, I own a cool JPEG, to, I am a customer using a useful fintech product. That is a massive leap in perceived value. It bridges that very difficult gap between the purely digital world and the physical world we all live in.
Now, let's contrast that with the other massive narrative of the last year or two, AI coins.
A very different story there. The AI crypto bubble seems to be bursting, or at the very least deflating, very rapidly.
Coins like Tensor, Virtuals, I mean, they were the absolute darlings of the market not long ago.
Everyone was searching for them. They were the next big thing. The narrative was unbeatable. But if you look at the prices now, they're falling hard.
Why? I mean, AI is still the biggest theme in all of tech, by far.
It is. But in the crypto space, investors are starting to notice a huge gap between the buzzword AI and the actual revenue or utility of these tokens.
Right.
Investors in 2026 are getting smarter, they're getting more discerning, they're looking at these AI protocols and asking, okay, this is cool tech, but where's the money? Who is actually paying to use this service?
They want to see the receipts. They want to see a business model.
Exactly. The token price was way up here, floating on pure hype, but the actual revenue and utility was way down there. The market is now brutally correcting that imbalance. It shows that 2026 investors are pickier. They want tangible utility, like a Visa card you can use, over vague promises of future AI integration.
That's a really, really important distinction for this market cycle. Utility versus vaporware.
It is the defining theme of this cycle. Don't just tell me what it promises, show me what it does.
Okay, let's bring this all together. We have covered a lot of ground today.
We certainly have.
Time for a quick recap. First, we have the tug of war in Bitcoin. Retail is shaking in their boots. The fear index is at a 5. But the big boys, Michael Saylor, BlackRock, are buying billions of dollars worth with both hands.
It's conviction versus caution, playing out in real time.
Second, regulation. The Clarity Act, our great hope, is completely stalled because the biggest banks in the country are terrified of stablecoins stealing their deposits by offering a better deal to consumers.
The battle for the future of yield. It's the legacy banks versus the new technology.
And third, XRP. It has finally graduated. It's in the institutional league now. It's got Goldman Sachs on board. It's got a seat at the table with the CFTC. But that maturity comes with a price, literally. The price targets are becoming more conservative and, well, more boring. $2.80 instead of $8.
Welcome to the big leagues. It's not as exciting, but it's real.
So after all that, what is the final provocative thought for our listeners today? What should they be mulling over as they go about their week?
I want to go all the way back to that stablecoin fight in Washington. Here's the question. If the banks win, if they're successful in lobbying to get a ban on interest for stablecoins written into the Clarity Act, does that actually kill a major crypto use case?
Mm-hmm.
Or does it do the opposite? Does it force crypto to evolve into something even more powerful, something the banks can't control at all? Does it push all that innovation back into the shadows of DeFi, where permission isn't asked for?
That is a scary thought. If you block the official front door, people might just decide to blow a new hole in the back wall.
And one more thing. If that Standard Chartered report is right, if crypto assets like XRP really do start trading just like a boring old tech stock with predictable, modest, single-digit annual returns, is that actually a good thing for your portfolio? We all say we want institutional adoption, but are we as a community actually ready for institutional returns?
Be careful what you wish for, right? You might just get it. The good and the bad. That is going to do it for this deep dive. Thank you so much for joining us in the complex, messy, and absolutely fascinating world of 2026 finance.
Stay curious out there.
We'll see you next time.